at the end of the day, what has happened the last 18 months is that more than anything, the rate of inflation has actually been what has dictated Fed policy and not the other way around. The Fed has been reactionary, and I think that the rate of inflation is really what's in the driver's seat here. And obviously, the market had to swallow it after March's inflation rate printed. And here, there was some concern that we were going to have as high of a rate of inflation as we did last month.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, hey, inflation is proving to be sticky. Is that the next step from transitory? What comes after sticky? That's what I'd like to know. Well, Ted Thatcher is with us now. Ted, great having you back. So, sticky? What does that mean? Sticky is like, you go to the movie theater and you're walking through the aisles and your feet kind of stick to the floor. That's what I think about with sticky. I don't think of inflation as being sticky.
Sure. I can actually feel the soles of my shoes, I think, when you say that, actually just grip the ground. I think, you pose a really nice question there, which is at first it was transitory, then it was, peaking. Now it's sticky. Where do we go from here? And I think we're in this place, Kerry, because at the end of the day, what has happened the last 18 months is that more than anything, the rate of inflation has actually been what has dictated Fed policy and not the other way around. The Fed has been reactionary, and I think that the rate of inflation is really what's in the driver's seat here. And obviously, the market had to swallow it after March's inflation rate printed. And here, there was some concern that we were going to have as high of a rate of inflation as we did last month. It's a little less than expected, or a little less than that last month, rather. But it's not gone. And as much as I think that, there's this political pressure and the market's desire to lower rates, it's just not happening. And so what comes after, what comes next, I think, is we're in these doldrums. We've said so long interest rates are going to be higher than we'd like for perhaps longer than we anticipated. And I think that this just proves that point continually. And, we kind of joked beforehand saying it might be cemented. And I think we're kind of seeing that.
Yeah, well, permanently affixed in place. But hey, don't worry about it. They're going to focus group test another term that says it's prolonged, but it's easing or something like that. Or it was bad, but it's getting better. It's all Fed speak.
Sure.
It's just,
I think, absolutely. Word salad, as they say. I've seen soothing, soothing. Do you feel soothed? I'm not sure that I do. I actually, not to go too in the weeds here, but I actually saw a really, really interesting breakdown from Larry Summers, the previous Treasury Secretary, of course. You and I have discussed before how the way they calculate the inflation CPI data now has changed so much from the way it used to be calculated. Of course, nowadays, they can use proxies, supplements for different, aspects of the underlying data. And one thing that Larry Summers released on X a couple weeks ago, I think it was now, a semi-viral thread breaking down the way he tracks inflation, the way it used to be calculated. One of the significant considerations that they no longer put in the CPI data is the cost of borrowing for consumers.
Really?
On top of using these different proxies. And so by Larry's calculation, the inflation rate, the CPI rate, did not peak around that 9% figure that has been thrown around so often, but closer to 20%. Of course, that just being over one annum, not the total rate of inflation over the last several years. And so that, to me, really matches much more with what I would say I experience when I go to the grocery store or fill up my vehicle at the pump, and certainly matches much more with what I find folks experience just in day-to-day conversation.
Hey, John Williams, shadowstats.com. When you look at the numbers the government's putting out, he still calculates it the way they did in the 80s. And it's not too pretty here. And obviously, it's very difficult to figure out inflation. We didn't have iPhones back in the 80s. Maybe that makes it easier to figure out the inflation rate, or at least to see what the real rate is. But things were a lot different. They always talk about substitutes. So steak gets too expensive. Then you substitute hamburger. It gets too expensive. Then you do chicken. And then that gets too expensive. And you substitute Spam. But, it's ridiculous because your eyes are not lying. And they're not putting in debt payments in the inflation rate just shows. But we do have an election year. They have to cut rates, don't they?
So this is absolutely, I think, where I would take the conversation to, because, sure, in its purest form, maybe the Fed would only operate with the data itself, right? The inflation rate and the unemployment rate. We've already discussed the issues, the way they calculate those numbers. That is to say nothing of what you just brought up, which is the incredible political pressure that is now placed on the Fed, a more and more politicized organization, unfortunately. And so now when we look at the futures markets, the market is pricing in, I think it's around a 70% likelihood chance now that we will get a interest rate decrease literally in September before the election cycle. Of course, I think President Biden would prefer that to, I would say, sort of put some proverbial lipstick on the pig to prop up the value of financial assets going into election season. And, I think that the market for a minute there, after last month's, the March inflation print data came out, kind of corrected a bit because of how sticky inflation has been. It just makes it that much harder for Jerome Powell to have a justification to lower rates. Up until, I think it was 2 Fridays ago now, the labor market data came out. And the labor market had, I believe, lost more jobs than it had in 6 months, or the rate of new job growth was as low as it had been in 6 months, which is, of course, the other analytical piece that the Fed looks at, the unemployment rate. And so I think that Jerome Powell will use the cover of those types of soft jobs numbers to justify what will end up being, in my opinion, a reasonably likely political move of a rate decrease potentially later this year.
All right. Well, hey, transitory, I always say, Ted, the best things in life are transitory.
I think Jerome would agree with you.
All right. Hey, looking at the Fed's two conflicting, and I would argue they have 3 functions now. Number one is ensure stable prices. Number 2 is ensure full employment. And number 3 is to make sure the stock market never goes down.
Indeed.
It's 3 plates spinning in the air. And, these Fed guys, man, they could be in the circus juggling dishes, right? Getting those dishes to stay up in the air.
I think that they would say that their jobs are so hard, but I would say, look, that they just keep putting out, like we said before, this word salad. And yes, I effectively agree with the last, joke of the comment there a little bit, that they are trying to keep the market up. Again, at the end of the day, it seems like it's been a political game as much as an analytical one, unfortunately. And ultimately, I think that it really erodes confidence of the American consumer. Because you and I, like you said before, our eyes aren't lying to us. And so we have this huge discrepancy, this chasm, really, that's been created between what's happening on Wall Street and what's happening on Main Street. It's this huge dichotomy, especially when you combine what we've discussed today, even just to put a pin in it, of such high inflation, combined with slowing job growth. And so if the average American is not seeing their wages increase coincidentally with the rate of inflation, if there's less jobs available, if everything's more expensive, we're all looking at each other, asking what's happening here. And at the same time, we're getting headlines of the market reaching all-time highs or approaching all-time highs. All those things can only be separated for so long, at least in my opinion.
Yeah, something has to give, right?
Absolutely. I think so. And I don't know if we have the perfect answer to that. Everyone has their proverbial crystal ball. I think if there is a likelihood of such a large amount of political pressure this year, if we do lower rates, inflation aside, I think it's more likely that we might get a sort of melt up in the markets before we actually saw that crash down. Again, depends on how heavy-handed the Fed wants to be.
All right. Okay, so when we have this conversation come January 1st, Ted, where are we going to be?
Well, the truth is, Kerry, if I had to guess, I think we will see at least one rate decrease this year, perhaps two. Again, it ultimately comes down to how heavy-handed that political pressure is and what the Fed does. But I'd be very surprised if we didn't still have some, let's say, sticky inflation and a lower, albeit maybe slightly, interest rate environment, to say nothing of, the potential banking consequences that might be on the horizon.
Okay, so when we look at that sticky inflation, if you will, right, how bad do you think it's going to be?
Well, I mean, essentially, we've seen this annual year-over-year rate stick around the 3.5% mark. As of, this recent month's print, it's at 3.4% year-over-year. Again, that's not considering the other adjustments you and I have discussed today. How bad can it get? Well, I think if they're willing to lower rates, they're willing to have, ultimately more moving money around in the economy chasing the same goods and services. It wouldn't surprise me at all, although it might take time to lag, if we saw, rates certainly in the high threes in terms of inflation with the way the CPI is currently calculated. And I just think that means that the Fed has said, tongue-in-cheek perhaps, or just in their own silence, that they are betting that and the average American is willing to accept an inflation rate in the 3 or 4% range instead of the, alternative consequence of dealing with rates that are on the interest rate side even higher than they are today.
All right. Hey, Ted, just tell us where we find you, how we connect with you on the web.
Oh, I appreciate it. You can find us at brightlake.wealth.com.
All right. And the link is in the show notes to this interview on financialsurvivalnetwork.com. Please go there, sign up for your free newsletter, click through to Ted's link, and connect with him. Ted, appreciate you coming on as always, and we'll talk to you again real soon.
Thanks, Kerry. Have a great one.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.